Well, everyone, it's the end of an era. In mid-March, we saw the Bank of Japan raise interest rates for the first time in 17 years. But it wasn't just them raising interest rates. The symbolic meaning behind this is that they were the last central bank that had adopted negative interest rate policy to actually abandon that and raise interest rates into positive territory. Hi, I'm Megan Horniman, the Chief Investment Officer for Verdence Capital Advisors. We're coming to you today to give you an overview of our first quarter white paper, where we discuss what negative interest rate policy is, why is it adopted, why the Bank of Japan was finally able to abandon this policy, and what this means for global assets going forward. Central banks around the world use monetary policy as a tool to stabilize inflation and either promote or cool down economic growth. When the economy is firing on all cylinders and inflation is a risk, typically you see central banks raise interest rates, like you've seen the Federal Reserve do through 2022 and 2023. But on the other side, when the economy is slowing substantially and now deflation or disinflation is a risk, you'll see central banks cut interest rates. Now, negative interest rate policy is not a traditional monetary policy. It's actually used as a last resort. It's used when a central bank has cut interest rates all the way down as low as they possibly can, and they're still not stimulating growth or pulling inflation out of that deflationary spiral. If you can see in this chart, we've seen both the European Central Bank and the Bank of Japan use this policy in order to support their economic growth. The European Central Bank did it in the aftermath of the Great Financial Crisis, the European peripheral debt crisis, to avoid being in this disinflation period. The Bank of Japan, similarly, has been fighting a deflationary spiral for years, and they needed to resort to this last attempt with monetary policy. Now, just to explain very briefly what it means, basically, banks are not giving you any money to hold deposits any longer. Banks are actually being charged from their central banks to have deposits in their banks. The central banks want to incentivize not only banks, but consumers to get their monies out of the bank. Don't hoard that cash. Get it out and put it into the economy. That's why they put interest rates all the way down into negative territory. The Japanese economy has struggled for many decades with weak economic growth, which has also led to a deflationary spiral in prices. This started with the bursting of the real estate bubble and the stock market bubble in the late 1980s and early 1990s. It led to deep recessions, massive economic volatility, and just stagnant economic growth. What we saw in the early part of the 2000s is that the Bank of Japan got on a little bit of a footing, and early on, right before the financial crisis, they were able to raise interest rates a little bit. But that the financial crisis, some demographic issues, emerging Asia, currency volatility, all these things have led the Bank of Japan to keep interest rates basically at zero, and then in 2016, they were forced to implement this negative interest rate policy. So what's changed? What we've seen from an inflation standpoint, as you look at this chart, is that Japan is not immune to this global inflation story that's been happening since the pandemic. They finally haven't been able to get inflation up above their 2% target. The second, and one of the more important things, is wage inflation. They have not been able to really get consistent wage inflation, and that is important. But they're finally seeing that. And what we saw this spring, which was one of the drivers for the Bank of Japan to abandon their negative interest rate policy, was that their major labor unions came forward with one of the biggest annual increases in wages for their employees. This had the Bank of Japan concerned, and this is one of the reasons why they did abandon that negative interest rate policy. The recent move by the Bank of Japan was not a shock to investors, so we haven't really seen an immediate impact in either the global bonds or global equity markets because of their move. But what we do have to accept that they were the last man standing. We are in a higher interest rate regime, even though many central banks may raise interest rates this year. The trajectory for the Bank of Japan is clearly higher, it's just the timing and magnitude is unknown. What we can see for bond investors is that they're finally earning some yield on bonds, not just in the US, but also in Japan, where they had negative interest rates. In this chart, you're seeing that the amount of negative yielding debt around the world went from about $18 trillion to less than $500 billion at this point. Now, going forward, the biggest risk to the bond markets we see by this action is in the Treasury market. We are concerned because Japan is one of the biggest holders of U.S. Treasuries. And in order for us to continue to support the supply that we're going to see over the next 5 years in Treasury debt, which is about a 30% increase, we can't have any threat to the demand side of it. If Japanese investors are getting positive yield in their own country, they may not be so inclined to come to the U.S. to get yield. From an equity perspective, specifically within the Japan equity markets, some of the winners to this will be the major banks. They're finally getting some interest rate spread there. Insurance companies, this benefits insurance companies. The energy-intensive sectors, because now if the yen does eventually strengthen, they can buy commodities for cheaper. Those are some of the areas that will benefit. The ones that we wouldn't say necessarily losers, but we think maybe the laggards will be real estate. There is a significant amount of homeowners that take out floating rate mortgages, and they will continue to increase if interest rates keep going higher. This should hurt the hospitality sector as well, because tourism is a big part of the Japanese economy. And what we see when the yen strengthens is that it's more expensive for international buyers to visit Japan. The small cap area, we're concerned about that because of the amount of zombie companies that are in Japan. These are the companies that have been able to support their debt load through this negative and zero interest rate policy because rates were so low. That's going to change. The Bank of Japan's move was not a shock to markets. That's why we didn't see a major market move in either the bond markets or the equity markets. But it does have a symbolic meaning. They were the last man standing with negative interest rate policy. We often have talked about how investors need to get accustomed to a higher for longer interest rate environment, and this just really solidifies that. While they've been hesitant to commit to any further rate hikes, clearly the path forward for the Bank of Japan is for higher interest rates. So what we have to be careful of is looking at bond exposure, not just in the U.S., but globally, making sure you're not overextended in duration and increasing your interest rate risk. We'll continue to monitor how we're positioned in Japanese equities. We'll make sure that our managers are actually looking at specific sectors that can benefit and not lose out from this action. As always, if you have any questions or comments, please feel free to reach out to your financial advisors. And I also invite you to log in and sign up for our Markets with Megan podcast. It's a quick, a few times a week, snippet on what's going on in the markets, outlining economic data and what it means for market moves. Thank you again.